Welcome back, and hello if it's your first time. Today we're talking about fixed rate mortgages versus adjustable rate mortgages. Now, I've been doing this for 20 years, well, 19 technically, and adjustable rates in this time frame have been few and far between, very few and far between, because rates have been so low. Now, as we're seeing rates really rise and really rise quickly, adjustable rate mortgages are now starting to kind of trickle back in, and I feel like it's really important to talk about. Now, again, my name is Stephanie. I've been helping people with their financing for almost 20 years now, and I'd love to help you. I'm at 985-300-LOAN or weeksteam.com. Please be sure to like and subscribe and share the video with your friends and family. We really want to get the information out on adjustable rate versus fixed rate mortgage. So which one you should do? Let's start there. I'm not a gambler, and I don't think that you should be a gambler either, especially not with the roof over your head and those that you love, the roof over all of y'all's head, right? So an adjustable rate mortgage to me is very scary unless I have some definite answers. And some of those definite answers would be things like, I know I'm going to sell or pay off this house before that rate adjusts. Adjustable rate mortgages are typically things like a 3-1, a 5-1. What does that mean? 3-1, it's fixed for 3 years, and then once a year, the rate can adjust. And then there's gonna be a cap. Okay, that's all going to be on your paperwork. Now, I'm not going to do personally a 3-year adjustable rate mortgage unless I know that I'm selling or paying off by then, because I don't know what that adjustment's going to be. And I know that since the 90s when I financed, before I was financing people, rates were at 8%. And so I don't want an adjustable rate that, and I'm not quoting a rate here, I'm just giving you an example, that maybe a 4 or 5% interest rate. For 3 years, it's a jump to 8, and now I can't afford my house anymore. That's not a position I would want to be in or put anybody in. A 5-1 arm would be it's fixed for 5 years, and then it adjusts once a year, and then it's got the caps. A lot of times the caps are 226, okay? That means it can't go up any more than 2% on that first adjustment, 2% on that second adjustment, and 6% over the life. So let's use actual numbers. Let's use simple numbers. It's been a long day. Let's say we started out at a 4% rate. Now 3 or 5 years have passed. I'm in my first adjustment. The max it can do to is 6%. Now I'm in my second adjustment. The max it can then jump to is 8%. And between all of the adjustments, I can't go up any more than 6%. But what that means is that 4% rate has a potential to jump to 10%. Let's run some numbers real quick. Average loan amount in this area is $275,000. Okay, let's do 4% versus 10%. 4% interest. Where's my thing at? Okay. 10%. Wow, I'm gonna do that again because I like to do the numbers twice, because when I'm dealing with people's money, I like to be super, super sure. And I don't always trust the calculators. Yep, okay. So the house that you got on an adjustable rate at 4% is $13.12 a month. If that jumps to 10%, that $13.12 a month jumps to $24.13. Deep breath, because that is a lot. So you want to weigh very heavily and take a lot into consideration when you are considering an adjustable rate mortgage and whether or not it's good for you. We talked about the adjustable rate. We talked about some of the terms that apply to the adjustable rate. Let me give you some examples of when adjustable rate is preferable. Over the years, the very few adjustables that have come across the desk were people who are transferred every couple years for work. And so they know they're moving consistently every 2 years. So they do a 3-year arm, or they'll maybe take a 5 if the rate's really, really similar, just to have the safety net in case something changes. That would be an example. If you're trying to buy a house and you're getting an adjustable rate to make the payment affordable, stop. Please do not do that, because it's only affordable for 3 years or 5 years. And then what are you going to do? Are you selling the house? Are you buying another house? Like, I know we have plans, and I know plans change, and I know life throws a shit ton of curveballs that none of us want to deal with. So I want you to take those things very much into consideration when you are deciding on fixed versus adjustable. If it were me, I always just really, really, really would want to do the fixed rate any single time that I can. Now I've got a few comparables here. And again, these are just for comparison's sake. This was stuff pulled from the internet. I am not quoting an interest rate, and these are definitely outdated. I can say that for sure. Okay, so a loan amount at $461,000 with an adjustable rate at 1.85% compared to a fixed adjustable rate. I'm sorry, a variable rate, which means it's not adjustable. I mean, it's always adjustable. It's not fixed at all. Versus a fixed 5-year, like we talked about the 5-1 arm, being at 2.89%. So the difference is at 1.85, you're paying back a total interest over 5 years of $62,842. Compare that to the 5-year fixed at 2.89, where you're paying back $77,000. So you can see kind of that difference. That's based on the 461. So that's just one, just one example. But ultimately, you want to do whatever makes you comfortable. Whatever your gut tells you, go with your gut. If it sounds too good to be true, it probably is. If someone's trying to sell you an adjustable rate mortgage and you're not insanely savvy and you don't have a plan and you don't have a bunch of money in the bank to pay off the loan in case something goes south, it's probably not a good idea for you unless you know you're going to be moving or coming into some money where it's going to be paid off. So be sure to ask a lot of questions. You want to know the interest rate, you want to know the caps, and you want to know what you're getting. 1, 3, 5, 7, or 10-year arms are what is most typically available. More typically available would be the 3-year or the 5-year. And you want to know the adjustment period, and you want to know the cap. Please, please, please make sure you know this information before you sign on the dotted line and put yourself at risk by doing an adjustable rate. Just like everything, there is a time and place for everything, so it can be done well and utilized in good ways for certain situations, but those situations are not the norm. I hope this helps. Thank you so much for tuning in, and I look forward to seeing you in the next one.